Hey Rob.
Hey Tammy, how's it going?
Good. How are you doing?
I'm doing pretty good. Already been a packed day. Had just came off another live interview.
Oh, wow. Look at you. That's awesome. Well, nice and warmed up then, huh?
Yes.
All right, great. So what we'll do is we'll get started here in just a few minutes when everybody is in. Um, Ken, who is our co-host here, is going to put everyone in breakout rooms. They kind of just network for about 10 minutes with each other, and then we all get back together into our main presentation room where I'll just quickly introduce you and you can go from there.
Okay, sounds good.
Awesome. All right. Well, thank you again for being here with us today.
Then from here I go to speak in person in Los Angeles.
You're kidding. You are busy.
It's a busy day, but the most busy will be at the end of the month. I fly to Florida. I speak. We do dinners. Then the next day I go to New York. I have
Wow.
New York Stock Exchange interview, NASDAQ interview. I speak again at another conference. We do another dinner, and then head to the Hamptons to meet with Senator Booker.
Wow. That's a whirlwind press review there.
Yeah, we're actually going to bring we're going to bring somebody to kind of film how all that happens, you know.
Oh, nice. Well, that's great. That's great to stay so busy too. So
yeah.
hey, Chris. Hey, Kim. Good to see you both in here. The early birds. We'll just wait a few more minutes and then Ken, when do you usually put everyone into breakout groups? Is that I'm sorry, everybody. I haven't been in the group mentoring in a while. Liz is out today, so I'm kind of co-hosting until she gets back next week.
Yeah, we can start the breakout group, and then after that, we're gonna come back, and then Rob we're gonna present. So that's the format.
Okay, great. All right, I see more people are kind of trickling in here at the bottom of the hour.
And how long does this go for?
The breakout group would there's gonna be like 10 minutes or so. And then
Okay,
after that, we're gonna come back and then you're going to present. And then
ah,
after that, we're gonna move on to the question and answer.
awesome. I have so much going on. I didn't realize I was presenting like a formal presentation, but I can do it. No problem. I do it all the time.
Okay. All right.
Hey,
Yeah,
Rob,
yeah,
you don't have to be as professional as you want to be. It's always nice when people can bounce questions off of you. So,
Yeah.
uh,
So what I like to do is just kind of give just an education of everything. Did you want me to formally present our fund? Happy to go either way. But you let me know. What we usually do is educate people. But I'm not sure what the lane is here. I'm happy to do the fund. And that sets the basis of why we're the leading educator in this sector.
I could go either way on that, Rob. I mean, it's not a sector I'm really very familiar with, but I've heard some good stories. I've got,
All right. Well,
again, I always love learning about new stuff. So whether it's your fund or education or a mixture of both.
Yeah, and it will be for sure a mixture. How much time do I have to talk exclusively? That maybe that'll help me.
yeah. Usually we run for about an hour. So if you want to go 30, 45 minutes, and then we can leave time for questions unless you
Oh,
want to like
okay,
take in
perfect.
questions as
So
you're
it's just
going
me.
along and
Okay.
presenting.
Then I'll
Yeah.
present. Then I'm going to present the fund. Then if it's a full hour, and I'll jam through it. And the questions is the best part as well. So
Perfect. Okay.
okay. Well, are we waiting for anybody, or do we just start recording?
So, Tammy, would you like to start
Mhm.
now? I can break them to the group now.
Sure. Okay. All right. Yeah, Rob, usually they do a quick breakout. Just everybody kind of networks a little bit beforehand. So yeah, we might as
Okay.
well do that. Ken, is it usually 10 minutes about we do?
Mm-hmm.
Okay.
All
Sounds
right.
good. All right. Thank you.
You're
Okay, so you're
welcome.
gonna be doing your own thing for 10 minutes?
Yes.
Yeah. Yeah, Rob.
Fair enough. Okay, I'm ready when you guys are.
Okay. All right. Awesome.
creating a real security.
Hey everyone, welcome back. Thank you for being with us here today. So we have Rob Seacrest here. He is going to be our guest presenter for the day. He is the co-founder and president of Polaris, and I'll let him go ahead and get started. Rob, thank you so much for being here.
Well, thanks for having me, and I look forward to speaking to your group.
Awesome.
Okay, well, do you want me just to go ahead and start, or is there anybody that's hosting? Okay, fair enough.
Yeah, no, go ahead.
All right, gotcha. 1 second. All right, so let me just first give you a little bit of background about me and who we are. So my name is Rob Seacrest. I am the co-founder and president of Polaris Capital Group. Polaris Capital Group is an asset manager that focuses on private credit. We have originated thousands and thousands of loans on both residential and commercial transactions throughout the country. We have funded billions of dollars of transactions in our collective career. So I formed the company with my best friend in 2010. And today we have 12 people that work for Polaris. And today we're going to talk about the Polaris Fund. But I think it's important for you just to understand a little bit of what the Polaris Fund is, but just as importantly, how we got here. So the Polaris Fund is a private mortgage REIT that lends to owners of commercial real estate with cannabis use tenants. And I want to just explain to you how we got there. So in 2014, our local congressman was Dana Rohrabacher. Dana Rohrabacher passed the most consequential legislation to ever pass at the federal level in the country. And that legislation defunded the Department of Justice from any prosecution of a cannabis-related business in a medically licensed state. And so what that meant to us is, as a real estate lender, we had the skill set to do lending. We're actually experts in what's called value add lending, which is the build out or repositioning of assets, whether it's tenant improvements or ground up. And when that legislation passed, even though cannabis lending on commercial real estate would be legal from the state perspective, what we didn't want to have happen is that our borrowers' cannabis use tenant be prosecuted at the federal level, and that put our borrowers' income from that tenant in distress as they're fighting a legal battle with the federal government, or more importantly, prosecution at the criminal level. That wouldn't directly get to us, but it still could affect the valuation of the transaction, and it was something that we weren't willing to do yet. But when that legislation passed, we realized that this is the largest newly created asset class in the country. Excuse me. And today we know that this asset class, once it's all fully built out through all 50 states, is roughly $50 billion. To date, there's been about $4 billion of credit issued in the sector, and we've done more than $500 million of that ourselves. So that's just kind of the story of how we got here. So that legislation passed in 2014. We started analyzing the sector and making sure that we were comfortable with the nuances of what a cannabis use tenant would look like from a loan doc perspective, from a compliance perspective, and all the things that we needed to get comfortable with. And so in 2016, we originated our first cannabis transaction for what we would call specialty use lending with to a cannabis use property that allows for a licensed cannabis use tenant. So that started in 2016. In 2018, we launched the first dedicated fund for $100 million, and that was to streamline the process. So in between 2016 and 2018, we actually discovered that this asset class was so vastly superior to our traditional lending classes that we decided to become dedicated to the sector and left lending to any other asset classes. And so today we only do this sector. And the reasons that we felt that way is that, one, we had a very good understanding of what traditional lending looked like. And we also now knew what cannabis use property lending looked like. And so what the difference was is that we were able to get significantly more equity on a loan to cost basis. So we only lend up to 60% loan to cost on our bridge loans and up to 75% loan to cost on our fully stabilized. And in the current market for asset-based lending, those are significantly higher. On bridge lending, it could be up to 75 or 80%. And on fully stabilized, it could be 90% to 95%, or even 0% if it's a cash out refi of a property they've owned a long time. But more importantly is that the quality of the sponsors for these transactions were bank quality sponsors. So we were getting asset-based lending rates, but with better, tighter loan to value, loan to cost ratios, and the quality of sponsors that you wouldn't see in those other types of asset classes. And the last.
Rob,
Yes.
Can I just quickly, only because I'm not terribly familiar with loan to cost. I mean, obviously loan to value, after repair value. I'm very real estate centric. So if you can just, maybe break it down for me, what do you mean by loan to cost?
Yeah, so there's two ways of measuring value. One is loan to cost basis. So the difference with loan to cost as opposed to loan to value is loan to cost is you're utilizing what did it cost to build that. So if you spent $5 million on the purchase and you spend another $5 million on the building of that property, that would be a $10 million cost basis. Typically, the loan to value are going to be less than the loan to cost in almost every circumstance. So for example, if in that scenario, the $5 million purchase price, $5 million in improvement costs, 10 million cost basis, we would lend up to 6 million or 60% loan to cost. That property, when that property is completed, would actually be worth more than the 10 million because now it's fully built and fully stabilized. It'd probably be worth, let's just say 12 million. And so the loan to value on that, so the 6 million loan that we did would now be the basis divided by 12 million, not the 10 million. You with me now? Mostly,
because when you say loan to cost, I'm assuming that's the build out of a specific business, not just based on the real estate.
No, it's just the business. It's
okay.
Only aperture to the real estate, not the business. So whatever's required for that tenant improvements or the building of that property has nothing to do with the business. The business is a separate, that's not our direct borrower. That's the tenant.
Okay. So this is how you get around the whole.
Yes. Yeah. So our borrowers are the PropCo, single purpose entities that we lend to. Now, most of them are owner users, so they're related parties, but it's a separate legal entity.
Got it. And that's how you get around the banking, is that they're basically, the collateral for you is the real estate and whatever equipment they have.
Right.
I guess where I'm trying to wrap my head around is I know that there's some banking laws in terms of the cannabis industry. It's favorable to you because they can't get traditional loans, but I didn't know how you could get around actually getting paid and still you putting the money in the bank.
So that's a really good question, Chris, and it's actually the largest misinformation there is in the country.
Thank you.
So what people don't know is that on FinCEN's website, last year that they reported 684 banks are doing depositor relations for cannabis use operators, and that's both tier 1 plant touching with cash, and also tier 2/3, which is ancillary, which would be what we are. So the banking has been robust since day one. We have, even back in 2016, we've never ever seen a borrower come to us with a tenant that didn't have banking in place. So it is a complete misnomer. The reason
Explain that to me, because I mean, I've just seen show it like they're sitting on a ton of cash and they got no place to put it. So
yeah, I'm gonna answer that for you.
Ask, but it's just not now, or
no, I'm gonna answer it. So the causality of that problem has been misidentified. The reason that there's so much cash is that all cannabis business starts with the purchase of cannabis at a dispensary or wherever that might be. And because cannabis is still federally illegal, you're not able to use what's called the rails system, which is credit cards. And so if you can't use credit cards and you can't use the bank ATMs, you're forced to pay in cash. And so that's cash buildup starts at the not because there's no banking, it's because there was no way to process it without taking cash. So then now you have an issue where you have to have a suspicious activity report when you bring that money into a bank. Well, cannabis has its own suspicious activity report in MSARS that was written for the Obama administration, the Cole memo, that everybody follows. The guidelines are clearly written. Any bank, all banks, all 4,500 banks in the country could take cannabis deposits if they so choose. The reason they don't do it, it's not worth boarding $10,000 or $10 million to lose your banking license if you got it wrong. So the banks, the 684, have built out the compliance department to board that cash in each of the states that they're accepting the money. And so that's the reason. So everybody has gotten that wrong. And I speak with senators and congressmen all the time. And I explain to them, you're solving the wrong problem here. It's the credit cards need to be able to be utilized or it doesn't change anything. In addition to that, of those 84 banks, we've heard up to 400 of them are doing lending. We're tracking 4 dozen of them. We've been paid off by banks. So the fact that there's no lending, that's all a misnomer as well. Now, those banks are generally smaller state banks, community banks, but there are federally chartered banks lending as well. Our former bank was a federally chartered bank, and they did a very large transaction to a cannabis operator named AYR. But the banks just don't understand the specialty use nature of the sector. So they have to underwrite it to not what it is, to what it's not. And we've never seen an asset class in our entire career where you actually are underwriting to something, to an alternative use that the property is not what it is. So long-winded answer there, but great question.
No, I really appreciate it. And I guess when you say about credit cards, you mean that the end user can be paying with a credit card, which I see as
the purchase, the initial user, the initial transaction is starting with if the initial transaction can't be purchased done with credit card.
I mean, you don't have access. Do you have access to like ACHs and wires? No, right? Because
that's different. That's a different. So ACHs and wires can go.
Okay, then why wouldn't a dispensary just send cash with the wire over to the grower in that direction? It's because
yeah, happy. These are great questions, Chris. So happy to answer these. So you're in a different lane. So the retail transaction for the buying the cannabis starts, and we've got that clarified. So now what happens is that dispensary is sitting on cash. So that dispensary has the choice. Do I take the hassle of taking my cash and going and boarding it? And it used to be that you would pay 0.25% to just deposit your cash. Or do I just pay all my service providers with the cash? And so that cash all moves downstream. Now, anybody, once they get that cash boarded to whatever, if they're ancillary or direct in the business, once it's boarded, and it can be wired in ACH anywhere. That's all clear. That's a different system than the credit cards.
Thank you.
Yeah, no problem. And I love the questions because I speak all over the country about this. I'm speaking later today.
A lot of disinformation, so it's very helpful.
I usually start with that, but anyway, here we are. So anyway, 2018 we launched the fund. In 2020 we realized that this asset class was so unique that there was no data metrics for it. There's no COAST or CoStar to analyze lease rates and trends and market trends and pull all that information. But we had it. We'd already had 2,000 transactions that had rolled through to us. So we aggregated all that information. Then we decided to go out and map every single cannabis use operator license in the country, who owned it, what type of licenses it was, and where's the real estate, where's that address situated, who owns the real estate. Now we have all that mapped because we want to track all that. we want to understand what the market looks like from a more macro level as we're making individualized loans, because those data points didn't exist. So we started that, and we'll talk a little bit more about that later. Then in 2020, we were the first to get investment grade rated, and we got an FDIC insured federally chartered bank to issue us a warehouse line of credit. So we're showing the industry that these are all first. Nobody had achieved it. And so we were proving to the industry that it was possible, even for ancillary business like ourselves, to get specialty, we're borrowing what's called specialty lending from the bank. And we're showing that this is all possible. Then in 2021, we were the first to get investment grade rated. And with that, we brought in our institutional investors. We brought in credit unions. We brought in non-cannabis friendly banks into our bond offering. So an anomaly that you have banks that don't accept cannabis deposits, but yet they're still participating in our bond offering. Recently we were the first to get to be rated A flat, and we just got that updated here recently. So those are all some major achievements that we've done. Today we're managing about 384 million. We've been in operation since 2018. We have 5 years of audited returns. Our target yield is 12 to 15%, which we've achieved every year, and we've made our 60th distribution in a row. So move on here. So this is a little bit stale, but yeah, we've done over 500 million, 73 transactions. I think we've done 39 payoffs today. Our average loan size for our book is 12 million. The average loan to value is 57%. I would say that loan to cost is probably like 63 or 64%. Our weighted average for all the portfolio of notes is 13.7. And we raised 84 million in 2022, which was a difficult year to raise capital. And a lot of people think of this asset class as most people are in passive investments, and the mortgage REIT, the tax advantage is significant too, and I'll come back to that. But if you're going to have a secured cash flowing investment, one, I'd rather have it passive with a manager than trying to do it myself. But two is that if you're going to have some exposure to real estate, this particular asset class, cannabis use lending, is going to be less impacted by a real estate or economic downturn. And the reason for that is that the entire $30 billion of sales that happens each year, which will be 45 billion in the next few years, that's going to occur whether the stock market is going bad or if the real estate market is shifting. It all starts with people just buying $25 to $75. Now, the increase may not go from 30 billion to 45 billion as quickly, but it's still going to happen each year. And so our borrowers are not trying to sell these properties to exit them. Once they build them, they're specialty use and they're cash machines. They typically do $10 to $12 more per square foot than 10 to 12 times more per square foot than a traditional real estate of equivalent non-cannabis in that same property. So they're cash machines, and once you get it up and built and running, it just prints money, and you want to just make it more and more efficient. So, I've talked a little bit about our data-driven value-add lending. These are the states that our current portfolio is, and states we've previously lent in and already been paid off. We're a national lender. We'll lend in any of the 40 or so states that are today currently legal. I already touched on, we're targeting at 12 to 15% net IRR of all fees, and we make monthly distributions. So just to talk a little bit about those data points. So we're tracking 25,000 businesses across the country, 80 million square feet, 39,000 cannabis licenses, and 30 million of that is cultivation square feet. By the way, we've done 4.2 million of that. And 30 million retail square feet. And so all of these things are what we're tracking to have a better understanding of the market and make sure that we're making the best decisions that we can with the most real-time value information. We do have a couple of competitors that are publicly traded, but they don't have this data, and they've entered the space. And I think one of them entered the space in 2020 and another one in 2021. But they have a different lending model than us. They're more corporate debt that happens to touch the real estate. We're closer to the pure real estate lending model than they are. So this is kind of what that data looks like. We have a map perspective on it. So that this is showing locations of the businesses, and then we can drive in on any particular one. We can change the map. We also have dashboards. And now we have so much information that now we can start being predictive into where the markets are going into the future for each of these states. For example, Colorado has too many dispensaries per capita. We don't really do dispensaries, but that is a data point you want to know. We're watching each of these individual state markets as they go through what we would call the maturation to a fully stabilized market within each state. So I want to make sure we leave lots of time for questions. So I'm going to kind of just jam through some of this stuff. We in the origination, we look at the data. We look for experience of an operator. We have an amazing underwriting team that we utilize. We underwrite these transactions by looking for an experienced operator. So we've de-risked that. An extremely strong quality sponsor, and then the real estate is obviously an important element. But on the real estate, these assets it's not where it's the same where everybody says it's location, because these assets are actually built in specific areas where the excise tax is the lowest, so that cash generated off that property could be the most efficient. Where your real estate purchase price, you're not going to build a 30,000 square foot facility in downtown Beverly Hills. It just doesn't make sense to pay that price per square foot, and you're looking for labor costs. So all those elements go into these industrial or mixed use properties that we're lending on. Let's just talk for a minute about the private mortgage REIT, the benefits for the REIT tax structure. So it qualifies for a 20% federal savings on income distributed to the fund members. That's pretty significant when you have a 12 to 15% yield. Even at 20% of 15 is 3%. So you're picking up just from the tax advantage a significant additional yield net to the investor because of that structure. But another one that's super important is that our investors only pay taxes in the state that they or their entity is domiciled. And why that's so important is that we have income. Our fund is domiciled California, but we are collecting revenue from all over the country. And instead of having to file tax returns in each of these states that we're deriving income and pass that through to our investors, the REIT makes it so that the investors only have to file the taxes from our distributions in their state. And if it's a no tax state, then they have no state taxes. So I would say that more than half of our investors today are in no tax states, Texas, Las Vegas, and a big chunk in Florida. The other ones is that cleanses the possibility of UBTI for self-directed IRA investors. And we also make monthly distributions, or you can compound them for reinvestment. So that fact that we're doing monthly distributions means that if you're reinvesting, you're getting compounding 12 times. That's significant.
Quick question, Rob. Yep. Just if you can go back a slide, or maybe you're going to be explaining this here, but when I invest in REITs, very often you start bumping into qualified versus non-qualified distributions. And when you say 20% federal tax savings, are you talking about, what are we talking about here?
Yeah, so that is a 20% reduction in your Fed. So a qualified REIT dividend is income, not profit. Okay, so this is a debt fund, so we're kicking off revenue. You receive a 20% reduction in that tax rate. So if you were paying,
everybody does it if they own a corporation, kind of, or to a certain extent. But doesn't that
it actually works for individuals or corporations except C corps. And the only reason that I learned that, I have a C Corp there. I had all my stuff in and I had to frickin' move it all.
You moving into an S Corp or?
I created an LLC this LLC can capture it. So,
Okay.
but C Corps are the one that don't get that advantage.
But it's still taxed at, so it's not taxed at my ordinary income level then?
Correct. So all REIT income, not profits or any of that stuff well, actually, I'm not familiar with the equity REIT. We're a debt REIT, but it's a 20% savings on your federal tax rate. It's massive. It's massive when you have the double digit income that we have.
That is huge. Okay. I think I got a gist of it here.
Okay, sorry about that. Okay, so let's go to the next one. So we have two lending loan products within our fund. We have a bridge lending product, which is 12 to 36 month initial term. And that is for the borrowers to acquire and build out that asset. And once that loan is fully stabilized, they can then go into our fully stabilized loan product, which is a longer term, 2 years to 5 years. And that has a lower coupon on it and lower cost, but there's the property is cash flowing at this point, and we also are getting principal reduction on it as well. One of our recent companies, and this company has been in the news big time lately, is Terracin. This is a multi-state operator, often referred to as an MSO, publicly traded. We did a loan for them for $46 million, and that we typically underwrite to 2 to 3 times debt to income coverage ratio. This one was at 5x coverage ratio when we closed, and it only had one of the 2 properties cash flowing. The other property is up and running now, and it's cash flowing at 8x of the debt service. So it's an amazing company. They just recently were in the news that they were the first publicly traded company to be admitted to the TSX stock exchange, which allows for institutional investors. And they just yesterday, it was announced that Pershing now is allowing the custody of shares again for them. And they're the only company that can happen with currently. Amazing story. We've got such awesome stories with all these cannabis operators. Another one that's really interesting is that so far we've been talking about the cannabis industry as it relates to state licensed operators. Well, most people would never know that there's already a landscape of federal licenses. Those federal licenses mean that if it was issued by the federal government, that it's not federally illegal for them, and they're purely for research. And those licenses can cross state lines. They can import and export out of the country, but they must stay within the federal license network for research, but they can also sell to government agencies. What we did is we funded one of the only 7 cultivation licenses that are existing and will exist in the country. And of those, one of them is the University of Mississippi has one of them. There's one other cultivator that is looking to build a facility, and then there's ours is the only one that's of this size and scale. This is a $20 million loan on a former Target retail center, and this company, just so you know, we have equity in this company as well as what's called an equity kicker, where not only do we get the coupon for our loan at 15.5%, but we also have warrants for equity. And this company is able to go public on the New York Stock Exchange or NASDAQ today because they're a federally licensed facility. And one of their peers already went public, and they didn't even have a facility up and running, and their market cap went to $500 million. So it's a really unique and different transaction that most people don't know that even federal licenses exist. So look, I want to make sure we leave lots of time for questions. I could go on and We've got 12 people on our team. Here's just a little bit of the layout of the fund. It's a private mortgage REIT. It's $1 billion fund. We're currently at about 384 million. Our minimum investment for retail investors is 50,000. Our target yield is 12 to 15%. Make monthly distributions. You can do reinvestment option if you want. We have a warehouse lines of credit in our bond offering. It's an evergreen term. The fund level liquidity is 20% AUM per year. Member lockup is 6 months, and the member level liquidity is the greater of 50,000 or 8.33% of their total capital balance. So what that means, if you've got $1 million capital account balance, then you would get $83,000 each month. If you have less than that, you'd get $50,000 each month. Our asset management fee is 1.5. Our hurdle is 8. And then our carried interest split is 20 to our side with no catch up. Each month is fully distilled and completed. That's it. Fund administrators Armanino. We utilize an FDIC chartered, an FDIC federally chartered bank. Legal counsel is Alston Bird, and we use one of the top auditors and the highest auditor you can get for Cohen Resnick. So that's just kind of high level. If you have information or want to get information from us, you can just simply email ir@floriscg for capitalgroup.com, and we're happy to send that and happy to answer whatever questions you might have.
Hey, Rob, Chris again. And I saw the target IR of 12 to 15%, but you also mentioned earlier that you pay dividends monthly. So how long before those dividends usually, and I know everything is different in what you're investing in, but is there typically a target time period in which you're not getting those monthly payments to when they start, or are those starting right away, or is there some preferred rate of return that starts right away or in a few months, or how that works?
Yeah, so I'm going to show you a summary of the life of the distributions right here. So originally we used to do quarterly. And so here's the summary of all of our distributions. And so this month,